Hey guys, welcome back to Be Rich. Before we get into the video, I wanted to bring to your notice that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it. And we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu, and these articles are also going to be made available for you in the Substack. The link is moat investing.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you. Hey guys, welcome back to Be Rich. Today we're going to be talking about Howard Marx's memo. All of you must know by now that Howard Marx is a channel favorite of ours, and I'm sure a fan favorite investor as well. So we decided to revisit one of his older memos posted last year. It's titled Fewer Losers or More Winners. It's a nice memo. It sums up his investment philosophy, and I think we have something to take out of it as well. So I'll just talk about what he says in the memo, and we can discuss his ideas. So before he comes into Oaktree Capital's philosophy, he says that superior long-term performance recorded by stringing together a run of top decile, that is the top 10% performance, is almost impossible. He says that it's very hard to be in the top 10% consistently. Instead, he says that you should strive, that Oaktree Capital strives to do a little better than average. So he says that by consistently doing better than average, he's already in the top decile, if not the top 1% of funds. And so this is a far cry from what we're used to, because generally we're all used to the saying that, look, you have to be in the top 1%, you have to be into the top 2% in anything you do. Being just in the top 40, 30% doesn't make much sense. Whereas Howard Marx comes here and he flips the script on us and he says that, look, it's fine as long as you're better than average consistently. In the long run, you're going to be better than most people. That'll immediately put you in the top 10% by virtue. And he says that relative superior results in bad times. So he says that most people focus on how to pump out the greatest returns during good times. So people take on a lot of leverage. People invest in companies like Nvidia with a lot of leverage. They engage in derivatives and then they trade. And then he says, look, that's fine. In good times, you want to outrun the fastest horse. But in bad times, you should make sure that you aren't losing more than what others are losing. Because if you do that, then immediately whatever good work you do in the boom periods is completely lost in the bust period. And moreover, we talk about Nicholas Nassim Taleb's point that you need to live to fight another day. You can't get taken out in the first bear market that comes about, or not even a bear market. If something goes awry in your company and it decides to tank by 20%, like Nike is something similar. Nothing major went wrong with Nike, but people have still tanked the stock. And if you had invested in, or rather bought derivative instruments regarding Nike with leverage, you would have lost a lot of money. So he says that to deliver superior results in bad times is through controlling your risk. And he says that it's less likely to produce extreme volatility. It's less likely to produce huge losses and more likely to work in the long run. And like our guru Warren Buffett says, the first rule of investing is to not lose money. And rule number 2 is don't forget rule number 1. So this is Howard Marx's main thesis. What do you think about this thesis?
Well, this reminds me of our cricketer Robin Singh, that being an all-rounder is far more useful than being a specialist. All things considered, you should be able to do a bit of this and a bit of that. Then you are very useful for the team because you can play in any point in the order. Same comes to when you want to be an investor. When you're picking a company, I rather pick a company which is like an all-rounder. May not be tremendous. It's not a specialist company. That's like Nvidia. It's a specialist company. You do not know if it's going to perform. And now that it's performing in hindsight, it all looks very clear.
Yeah.
Right?
Yes.
And we can talk about this, Nvidia and what's happened to Intel. But those things make nice headlines. But as an investor for the long run, I rather have a team of companies which are like Robin Singh. No matter what the conditions are, they're able to perform.
Even Dravid is one such cricketer.
Correct. Yes. Yeah. So, meaning they can perform no matter what the headwinds, tailwinds are blowing, whatever the geopolitical, regional situations are, their product and their services are such that people require it. Maybe in various levels of requirement might change, but it will be there required and they can keep plowing along. And I don't want any flashy CEOs. I don't want any flashy company. I don't want any flashy brands.
Or projections which are into the moon.
Yes. Those are all very nice for social media. It's all very nice for, consumption on media format. But as a personal investor, I rather be, like my dad will always say, I rather be rich and unknown than be famous and be poor.
Yeah.
Today's world seems to be, your generation especially, they rather be famous and be poor than be wealthy and be unknown.
Yes.
There seems to be a craving for some reason in this world that you want to be popular, you want to be famous, you want to be notorious, and even if you burn your pocket through, it doesn't matter. That is what is creating this burning craziness about trading and being a trader. That most traders, guys who get into it, don't even want to create wealth anymore. They just want to create some outlandish trade, so then they become famous. They all want to take some 1,000 rupees, throw it somewhere, and that's become 1 lakh, and then they take that 1 lakh, make it 10 lakhs, but not for the reason of even making money anymore. It is about being the notoriety of being like, I've done this, and be famous. And it's there for some reason, and you can see it. I think it's more of a mental health crisis which is happening to our society, not even investing, I would say. And his thing is very true. He's telling people to take a breath, take a beat, and to really think and assess why you're doing this and what is your motivation behind doing this. I don't know. If these kind of videos, that's why sometimes I wonder, do we really reach to our viewers? Do they really understand what he's saying?
But interestingly enough, our viewers are actually quite in tune with what we're saying, because the comments are very bright in the sense that I feel very hopeful when I read the comments. Also, thank you for mentioning that the Substack hasn't been recently updated. We are working on more recent updates. We've posted another one, and another one is scheduled for next week. So keep on the lookout for that. But I'm going to move on to another interesting thing he says. So he says that in equities, it's better to try to avoid losses. And he says winners will take care of themselves. He says if you don't lose money, then you're already doing everything correctly.
Yeah, your grandmother used to say this all the time. She used to tell me to save money, all you have to do is stop spending it.
Right.
She says the minute you stop spending money, you start creating lots of wealth.
Yeah.
She says the problem for me she used to say was that you keep spending too much. She says stop spending. When you get money, leave it with me here and go.
Yeah.
But of course, FOMO,
and so he expands that on and says that the best foundation an investor can hope for is the absence of disasters. He says that as long as you don't have disasters in your portfolio, you are set to outperform most of the market by virtue of being a small-time investor.
Yes, more than fixating on making winners, try and make sure you don't have losers.
Yes.
Makes sense. But people don't look at it like that. No?
Which is why we keep harping on about no debt, because by avoiding debt, you're already avoiding huge potential for disaster, because companies which are saddled with debt, like we discussed in the other video on Howard Marx's memo, where he says that debt closes out the amount of possibilities you can survive in. Very similarly, that's why we avoid companies with debt, because that is Buffett's first rule, that you avoid places where you could lose money. You have to keep your principle.
True. It's like being a good football manager.
Yeah.
You don't want flashy players. Yes, they make nice headlines. They help the club gain traction and create fan base. But as a football manager, as a team composite, flashy players are very painful to deal with.
Right, because you're paying a lot of money for them.
Correct.
And you are expecting a certain level of performance in anything. Even the smallest sprain can put them out of commission.
And end of the day, one guy cannot win the match for you.
You can't. And that's the case with Ronaldo being bought by Manchester United and then sold again. But anyway, you are I'm a Manchester United fan. So yes. You are a fan of moderation and temperance, which I agree with. So let's look at that aspect of this topic. So Howard Marx says, okay, we've talked enough about why you should manage your risk. But he says there is a difference between risk control and risk avoidance. He says that risk avoidance is returns avoidance. You cannot make money without taking risk.
Cannot.
This is something he says. So he says that, look, I'm not saying that you should take no risk. He says you should be taking risk, but you should be very smart about how you take risk. And he gives you 3 principles. He says, 1, risk has to be something which you're aware of. You have to be aware of what risks are entailed. That's the first one. This might seem very obvious to most people. It's simple to understand, but hard to implement because risks are usually unseen.
Yes.
And 2, he says these should be risks you can analyze. So it can't be risks of, let's say, me suffering from burnout or something, because that's not something you can analyze very much. But you can analyze risks of, let's say, a company not being able to make its next interest payment on the debt which they've borrowed. This is something you can analyze with the numbers in the cash flow statement. Third, he says that these risks are something you should be able to diversify. So we repeatedly say that, look, you should be investing in a basket of stocks. You shouldn't be, getting into one single stock. So the idea here is that you diversify your risk. Yes, one company can go awry, something can happen, regulation can occur, the company's money making moat goes away, but that doesn't mean it'll happen to the 9 other companies which you've bought, which is why we say that out of 10, 6 might go into a loss, but 4 will outperform the 6.
True, very true. But the problem here is where the problem is. See, more you diversify, the lower your risk is. Meaning, let's say you have 500 companies you've invested in.
Yeah.
Your risk is that much lower. That's why S&P 500 is such a safe bet.
Yes.
But the flip of it is, the more you diversify, the less you can see what's happening.
Yes.
Because the more you have to look at, it's like having more pots in the stove. So you do not know which is going to boil over. So you have, that's where it gets into a personal call. How much appetite do you have for investing? How much is this something you do full time or something you're doing part time?
Yes.
So based on that, more than just getting inspired by seeing a video or feeling encouraged by seeing one of your friends doing it, you should focus inward and say, okay, what is it that I really want? That's where I think most investors fail. They fail on the first initial, what is motivating you to do this, they don't look at. If you don't look at your motivation, you will not be able to achieve anything because you really don't know where you're going.
Interesting that you'd mentioned that, because the intelligent investor starts off by actually analyzing what kind of an investor you are. It starts off by saying that, look, what kind of amount of time do you have in your wallet to be able to give out for investing? What kind of mental makeup do you have? Are you a person who is a doctor, who's a young surgeon, who doesn't have much time, who has to be on call? Are you instead, a work from home techie person who has enough free time to be able to do what you want to do? Or are you someone who works as a teacher? It depends on where you are, and it depends on what your age is. It depends on how many dependents you have.
Correct.
And at the end of the day, you have to take a call on whether you can sit idly, see your stocks go down by 50%. That's something which can very well happen in the market. We haven't seen it very recently apart from 2020, but that is something
for
that
me
happens.
Right now, if I go into a room and I had to segregate people who will make great value investors considered from everybody else, my test would be to see how much can they put up with boredom.
Yeah.
I will crank up the boredom in the room to full maximum and see how many people are left standing after some time.
Just white
people,
balls.
yeah, the people who are able to put up with absolute boredom for the longest will make the best value investors, because that much of boredom you have to put up with to be a great investor.
Yes.
If you can sit and watch a snail crawl across the room for hours on end, you'll make a fantastic value investor. If you get irritated and bored within seconds and you're not able to keep your attention on that,
maybe indexing is your...
Indexing, you're far better off indexing and staying away from the stock market.
And that's still a decent chunk of returns. You'll still beat most of the active managers.
Yeah, and to be honest, you're really not... What you're looking at is not at investing. You're looking at something else.
Yeah.
Your brain is telling you it's investing, but actually, deep down, subconsciously, you're looking for something else. And investing seems to be just an outlet, that's something that's landed on your plate right now.
Yeah. And now we move on to why Howard Marks thinks Warren Buffett was successful. So he breaks it down into 3 points, A, B, and C. Let's go through the A, B, and C. A lot of his investments did very decently. They did decently, they did well, but they didn't do extremely well. Point number 2, a relatively small number of big winners that he invested in heavily and held for decades. And number 3, few big losses. This is where the boredom point comes in. For you to be able to be okay with point number 2, which is a relatively small number of big winners that you stay invested in heavily and hold for decades, that is something where boredom is going to kick in. For example, Apple, forget Apple, let's look at any company like Microsoft, Apple, Nvidia, any of these companies. If you had bought Apple in the 2000s and once Steve Jobs came back in and you said, okay, Apple is going to turn around, and a lot of people did buy back then, but then they couldn't hold it and they sold it off because they thought, okay, Steve Jobs is dead or whatever, and I can cash out, it's up 100%, it's up 200%. But that's the difference, because Warren Buffett doesn't usually sell. He still has his original Coke stock, which he bought all the way back then. And this is something which I was taught very, very strictly, because I kept going back and forth with my other uncle on, look, I've made so much money, why don't I just exit now and I'll buy it back later? And he keeps drilling it into me, saying that, look, you can't time the market. What if it doesn't go back down for the next 20 years? It's possible. You may have a very long bull run. given that the interest rate can go down to zero at any point they choose to, theoretically. It's
Like, it even go negative.
It did go negative.
Yeah,
It can even go negative.
Why does it have to be a zero? It can go negative.
It can go negative. So you'll feel like an absolute idiot for selling it off.
And we have a limited time in our life.
Yes.
So it can stay there.
Yeah, you can stay. And so the point is that you may not get the opportunity which you think you will be getting. There is no guarantees in the stock market. So better yet, if you don't need the money right now and you think the company, nothing is fundamentally changed in that, you keep getting these questions on Instagram. And I think this video should put an end to that question.
It never will. That will never stop. Because I'll tell you what's driving that question is for the mere fact that people don't want boredom.
Yeah.
I bought, let's say, Indian hotels at 30, 40 rupees. I'm sitting 600 plus now. I'll never be able to buy it at 30, 40 rupees if I cash it in.
You can't.
Yes, I'm in a bull market, whatever equation you say. But I can get bored of it. And when I get bored, I need to find some other outlet and not sit and do analysis of my stocks. You should only do analysis. This is why I keep saying, do analysis once a month. Check your portfolio once a year. Enough. Unless, like you rightly said, there's a reason for you to sell it.
Fundamental reason.
Yeah. The company is going bust. There's change in the sector itself. Like IC engines are dying and electric vehicles are coming. There's some fundamental change.
Yeah.
Then you need to visit it. But even there, you'll have enough time.
Yes.
To move and react. It is not something that you need to worry about right now. But it's a very hard thing to develop. This is where the funny thing about being a great investor, we talk so much about mental health, we talk about how to build character, how to do, meditation and all this. Reasons why we give you all these other tools is because all those other tools help you being stoic, helps you becoming a better investor because it just allows you to engage with your brain all the time. Because your brain its job is to generate thought.
Yes.
Its job is to analyze.
It's literally built for that.
Yeah. So if you open your stock portfolio, your brain will immediately start looking at it and start analyzing patterns and seeing things and, it will give you some kind of a solution. And everyone has biases and we're plagued with it. So you'll immediately latch onto your biases and you'll start moving towards it. So by practicing all this, meditation, stoicism and all this other things, it teaches you to decouple yourself from this constant requirement for noise.
Yeah.
We have this appetite for noise and we love it. That's the same reason why Trump is so popular. Because he loves generating noise and he knows his base loves the noise. People can't understand why is he so popular. Because even people who hate him sit and watch him.
Yeah.
Because you can't. Like a moth to a flame, we dance to it. But Howard Marks is right. Warren Buffett is fabulous when it comes to this.
Right. And the last point which Howard Marks talks about is the very sacred word of the investment and finance community, trading community, called alpha. So he says that alpha, which is technically considered the edge which you have over others or the outperformance that you have over others because of your inherent skill or whatever you know. He says alpha is simply put this according to his way of thinking. He says that you have to earn a return without taking the fully commensurate risk. That is, if your return is worth 10 points, and the risk which you're taking is only 5 points, you're a winner. If the return you're making is 2 points and the risk which you're taking is 10 points, you're probably losing out. So he says that alpha can be done in two ways. You can have alpha in two ways. One, reduce risk without giving up less returns. Or two, you increase potential return with a lower increase in risk. And intrinsic value investing, that is intelligent investing, is all about this. What we're talking about is you identify companies which are trading below their intrinsic value. So you basically reduce the amount of risk you're taking because a company doesn't go very much further from its intrinsic value. And the further it goes, the less your risk becomes. Because the fact of the matter is, Mr. Market may be as irrational in the moment as he wants to be. But at the end of the day, he does see reason. He does end up coming back to reality. And like Eugene,
but it may take a long time.
It may take a very long time.
Like Keynes said, we can remain irrational for a very long time.
But the key power which we have as retail investors is that we are not at a risk of insolvency because we're doing tiffin coffee investing. We're only investing how much money which you're spending for tiffin coffee a day. So the point of this is that tomorrow no one's going to hold your collar and say that, look, where is my money? The only person you're answerable is to yourself. And in this kind of scenario, you have an edge over other people whose collars will be held if the market doesn't realize reality before their clients get perturbed. So the point that we're trying to make here is that investing is not a fool's errand. It's definitely something where small time guys like us can definitely do some good work. But that being said, it's going to be a very tough process to go through it.
And most important thing you have to realize is this so-called bull run, bear market, all this doesn't make any difference. End of the day, you're buying a business, you're investing into a business. Remember that if there is value, if there is intrinsic value in what you're buying, you will always stand to gain. And stay in your circle of confidence. If you do not understand something, you do not know it, it's okay. Let everybody else do it. You stay in where you need to stay in your lanes and you work on that, you'll do well. And remember why you started it, like Sashwath was saying, what's your motivation to investing and what your goals are. And as long as you're going to your goals and you're achieving those benchmarks you want, the rest of it doesn't really matter. Who makes how much should not matter to you. What they do should not matter to you. If it's all that is important to you, then for heaven's sake, do not do investing. You will not do yourself any good by investing if you have a tendency of constantly looking over your shoulder to see how your neighbors are doing. Because this will only add further fuel to an anxious mind you already have. And this will not help you. No matter how much money you make, it will not help you. This is what my final advice would be.
Right. So that being said, thank you for watching this video. If you liked it, please hit the like button. If you are not subscribed already, please hit the subscribe button and the bell icon, because if you hit the bell icon, you'll get notified when we release a new video. And finally, if you have anything to tell us, please let us know in the comment section below. We do make it a point to read your comments, and we enjoy when we see positive comments about how you have taken up investment in your life. Again, thank you for watching. Be Rich.
I told you about visiting Singapore. The date has been finalized. It's 25th August. It's a Sunday. Those desirous of meeting me in Singapore can drop a message to the WhatsApp number given below or contact my team by an email. My team would reach out to you and we will assure you of our best services. For English and Hindi, there will be a separate meeting. See you in Singapore. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.